Welcome back. We're diving immediately into a submission, a high-energy technical analysis report on Energy Fuels Inc., ticker UUU. It's structured for video, making a very bullish, very contrarian case for a V-shaped intraday reversal.
And, right out of the gate, the strength here is just how immediately actionable it is. The analysis gives you these extremely clear, specific levels that any trader can use, like right now.
Right. The clarity on that defined entry zone, bracketed between $14.70 and $15, and that absolutely critical invalidation stop loss at $14.50 it's stellar.
Mm-hmm. That precision shows a real commitment to risk management, which is, it's the foundation of any serious trading decision.
It's more than just a setup, though. It feels like a fully contextualized trade idea. The report does a great job of integrating the macro narrative, for sure.
Highlighting the uranium and rare earth strategic status.
Exactly. Which validates applying a technical premium to the chart. It avoids that cardinal sin of existing in a technical vacuum. That really elevates the conviction level.
Okay, so those are the strong foundations we can build on. Now let's turn to the architectural challenge this analysis faces, connecting that short-term technical conviction to a massive long-term strategic target.
Yeah, that jump from an intraday reversal signal straight to a 52% upside target, the $23 mark, that felt ambitious. It's exciting. Don't get me wrong, it shows conviction, but that ambition also raises a structural flag for me.
That's the core issue.
It lays out a powerful short-term signal, but lacks the technical scaffolding to bridge that intermediate gap.
Right. When we look at a 52% move, we're transitioning from a short-term trade to a real position sizing decision, and that leap requires more than just conviction. It demands verifiable structural integrity across multiple timeframes.
So the material presents a compelling intraday reversal signal, but risks scope creep by immediately jumping to a long-term target without establishing the intermediate technical structure necessary to support that path.
And the weakness there is that while the analysis does a great job establishing the short-term reversal, based on that 1469 low rejection, the path to the third target, the dream, at $23, it relies too heavily on an external validation.
The analyst price target.
Exactly. And while those reports are useful for context, technical analysis has to be internally consistent. When the gap between the immediate setup near $15 and the ultimate goal of $23 is this wide, and the analysis only gives you one target in the middle, the swing high near $16.50, the ultimate risk-reward calculation just feels disconnected from the chart evidence. It's like we're outsourcing our maximum conviction rather than proving it ourselves.
Precisely. For a sophisticated trading audience, the question isn't if the stock can reach $23, it's how the technical structure facilitates that path beyond $16.50. This reliance on an external source, it just weakens the internal integrity of the whole analysis report.
So the suggestion for improvement here is critical. It's to integrate higher time frame technical structure into the analysis, to contextually validate that $23 target and establish essential technical milestones above $16.50. The analysis needs to visibly show that the current breakout setup aligns with significant historical accumulation or structural support and resistance zones. You have to prove it on the chart.
We need to see those waypoints. When a trade idea spans this kind of distance, you're essentially asking someone to trust the analysis for weeks, maybe months. And that trust is built on showing them exactly where the stock will face resistance and where it might find support if it consolidates, all the way up to 23.
For some concrete examples then, instead of just citing the external analyst target, use the source material. Identify and map out specific historical or Fibonacci-based resistance levels that exist precisely between $16.50 and $23. Show us the alignment.
And building on that, if the report includes a wider chart, say a weekly or monthly view, reference where that $23 mark sits relative to a major prior swing high, or maybe a significant historical liquidity zone from 2 or 3 years ago.
Or you could use a precise Fibonacci extension, like the 1.618 extension of the prior consolidation range, and show if it lands precisely at or near $23.
Right. That act of mapping internal structural resistance lends this overwhelming technical weight to the dream target. It makes the whole thesis internally complete and, analyst independent.
Okay, let's transition now to what I think is maybe the most compelling aspect of the short-term analysis, and that's the interpretation of that V-shaped reversal as a true institutional bear trap.
Yes, that is the narrative hook that sells the idea. The argument here is that the sharp wick down at 1469 represents aggressive institutional buying that rejected the lower prices almost instantly. It's a powerful story of conviction.
It is fascinating, and while the interpretation of the V-shaped reversal as a bear trap is powerful, the material could significantly strengthen the claim of institutional accumulation by incorporating quantitative volume evidence.
The weakness is that the central thesis, that this wick represents massive, aggressive institutional absorption, relies primarily on the visual price action itself. It's sort of the technical equivalent of just saying, I saw it happen.
Right. And in high-stakes technical analysis, confirmation requires the fingerprint of large-scale players. And that fingerprint is quantifiable volume. Was there high volume present during that specific 11 a.m. flush and recovery? Or was it just a quiet stop hunt that dried up retail liquidity?
Yeah.
Without confirming conviction with volume data, the rejection could be interpreted as merely aggressive short covering or simple stop hunting hitting low bids. And while that's still a valid signal, those are far less robust foundations for a major reversal than true institutional accumulation.
This distinction is everything, especially for a contrarian setup. Low volume on the rejection suggests a low conviction move. It's easy for the price to fall back down. High volume suggests massive capital was deployed to defend that level, meaning the next push higher is backed by serious money. We need that proof point.
So the suggestion is to absolutely bolster the price action breakdown section, which the report calls the story of the tape, by integrating specific volume data. We need to quantify the buying pressure to support the narrative that sophisticated players were accumulating, not just that retail stop losses were triggered.
You have to make the connection between the price movement and institutional conviction undeniable. For instance, you could specifically highlight whether the volume spiked substantially during the exact minute the price dropped to 1469 and the immediate bounce. That spike is the signature of aggressive buying absorbing every seller in sight.
Or alternatively, if the volume on the drop itself was actually below average, but then it increased dramatically and sustained that increase during the recovery from noon onwards, you would detail how that specific volume profile confirms the $15 level was held like a fortress by steady, consistent accumulation.
I see.
That means institutions stepped in as the market stabilized, showing calculated, prolonged defense. Both are bullish, but quantifying which scenario occurred is what elevates the analysis from just observation to high conviction evidence.
And it changes the entire probability assessment of the trade. If it's high volume absorption, that 1450 stop loss has a near bulletproof technical defense. If it was low volume short covering, the chance of a retest increases significantly. This is all about maximizing the robustness of your entry signal.
Okay, moving to the third key opportunity. I want to talk about delivery, specifically how the language in the analysis report impacts the perceived professionalism of the technical work.
Okay, so what I actually really like about this presentation is the high energy tone. It's clearly designed for a fast-paced video format, and it makes the material immediately engaging. Trading is exciting, and the tone reflects that.
I agree, the energy is compelling. However, we have to make sure that high energy and urgency don't compromise the analytical integrity.
The choice of high energy and urgent language, while effective for engagement in a video format, sometimes crosses the line into promotional hyperbole, potentially weakening the perceived objectivity and analytical authority of the underlying technical analysis report.
The weakness here lies specifically in the terminology used to define the core technical levels. Phrases like loads a boat and referring to target 3 as the dream. They inject this unnecessary emotional language and urgency into what is fundamentally a cold, calculated risk assessment.
Precisely. A serious trading audience, despite wanting quick, actionable insight, fundamentally prioritizes disciplined risk management. They are sizing positions based on probability. When the terminology becomes too sensational, it subtly undermines the credibility of the specific, well-defined technical levels that, ironically, are the best part of the report. It introduces an element of recklessness where there should be calculation.
It creates a cognitive dissonance, right? You provided a very disciplined, tight stop loss at $14.50, which signals responsibility. But then you encourage the reader to load the boat, which signals maximal, maybe even irresponsible exposure. The language should reflect the probability and structure you've identified, not an emotional imperative to buy.
I see what you're getting at. So the suggestion for improvement is to maintain the bullish conviction, keep the energy up, but refine the terminology used in the key technical level section. Ensure the language remains grounded in probability and structure, and that elevates the analytical rigor of the report. The analysis should scream conviction without whispering hyperbole.
Yes, we need to transition from subjective urgency to objective structural confidence. So for concrete examples, rephrase the load the boat zone to something like high probability entry zone or confirmed demand range. This still signals confidence in the level without sounding reckless or overly promotional. It tells a risk manager exactly what they need to know. This is where the market is likely to defend the price.
And critically, changing target 3, the dream, to structural resistance target, or maybe Fibonacci alignment target, $23. That achieves 2 goals at once. It keeps the numbers actionable and exciting because it's still a 52% upside projection, but it grounds that ultimate goal in objective structural measurement. It removes the emotionally charged phrasing that can detract from the seriousness required when projecting such a significant move.
The goal is to maximize the report's perceived authority. When you are asking traders to consider a massive position swing, the language should be professional and grounded. You need to ensure that the user understands that this is a measured, high-probability outcome based on technical evidence, not just a hope or a wish.
This analysis report on the bullish reversal signal in UUU is fundamentally strong. It offers highly specific and actionable levels.